One of the things that's caught my eye today is the retail sales numbers, the implications it has for the Australian economy, the implications that it has for the interest rate setting, and effectively the interest rates dictate what happens to property prices and asset prices next year. I don't like digging in too much into retail sales numbers because they chop and change. But I'm going to, on these set of numbers that have come out today for October, because they're important and because they're indicating a change in direction. And this, combined with other data that I'm going to show you that's come out over the past week or so, is starting to form a little bit of a case for the RBA to consider when they meet next week and how we go into 2024. So the October retail sales numbers were always going to be soft. And the reason for that is because the previous month had been strong. So everybody was expecting these numbers to moderate, but they've come in worse than expected. They've come in softer than expected. And retail spending actually fell by 0.2% compared to the previous month. Now, that's not huge, but we're supposed to be in an economy that has near full employment. We're supposed to be in an economy that has so much inflationary pressure that the Reserve Bank has increased aggressively over the past 2 years. Retail sales aren't supposed to fall. They're supposed to perhaps moderate a little bit, flatline, but not necessarily fall. And they've fallen. When I go down and have a look at the composition, they've fallen across the board. Food is the only retail segment that is held up, but a lot of the parts of the retail sector that had done well or that had perhaps overshot in the previous month have now pulled back. If you have a look at clothing, if you have a look at goods retailing, department stores, cafes and restaurants, all these things have significantly pulled back. And as you can see here, it's quite broad-based. So the pullback has been quite broad-based. Now, there's no doubt that the Reserve Bank increasing interest rates has played a lot into sentiment and will continue to do so. That is the whole point of increasing interest rates, because you want to pull back some of that demand that's in the economy so that you can balance demand and supply and you can reduce those inflationary pressures that are driven by monetary policy. So it's kind of working. The reason why I think this is important is because when I read the RBA's statement this month, it's quite a lengthy statement. It's probably a good exercise to copy and paste it and put it into ChatGPT and ask a large language model to actually break it down, because there's a lot of gibberish in there. One of the reasons why the Reserve Bank considered increasing rates was because the household sector was so strong. And I think the previous month's retail sales numbers somewhat spooked them. Not in isolation, but retail sales numbers combined with everything else, combined with the higher than expected inflation numbers. So there was an expectation around the table for the RBA. If we come down and we have a look at the consideration, whether they should or shouldn't increase rates last month, the discussion around the table was that the household sector is holding up better than expected. They're spending better, jobs are still there. We should move rather than wait till next year. These retail sales numbers tell a different story, and they perhaps show that the previous numbers were not completely accurate and that there's been a little bit of a lagging effect in the economy. In my opinion, I actually think that migration has distorted the market over the past year, because we've opened the migration floodgates, which is great, because we need migration for our economy to grow. But because it's happened in a short period of time, it's masked a lot of the uncertainty or the weakness in the underlying economy. And as migration starts to moderate next year, and as interest rates have been increased, you're really going to start to see the consumer pull back significantly. And I think this causes a change in the inflation numbers. Eventually, inflation numbers lag. And when the RBA sees that, they're going to be quite worried. They're going to be worried because perhaps they have overestimated how strong the consumer is. The jobs market is strong, but a larger part of the consumer's income is going towards servicing the impact of rising rates, whether it's higher mortgages, higher rents, or a lagging impact of higher inflation in the economy. So the statement was actually a lot closer. The decision was a lot closer than I think, having read the statement. So I'm just not sure if they're going to move again before the end of the year. I think what they do is they wait to see where the inflation data is. They wait until next year to see whether is this consumer really that strong, or are the October sales numbers an early indication of things starting to slow. I actually think that they will take that into consideration, having read this statement, and I think that starts to change the narrative slightly. I might be reading into it too much, but I think markets move. The big moves come after small pieces of data, early hints, early indications, and I think that the consumer slowing down is very significant, slowing down more than expected. Don't read too much into it, but take this in collection with a lot of other things. That's the way I'm reading it. I really think we're at the top or near the top of this interest rate cycle. Maybe there's one more, but then at some point the consumer slows next year. Unemployment starts to rise. The migration that's been coming in and masking a lot of vulnerabilities might not be a large enough factor, offsetting factor. And we're already seeing it in the US. Inflation's under control. Inflation's no longer the problem that it was 6 months ago. And eventually that starts to creep into the RBA as mortgage costs, rental costs are starting to really bite the consumer. I think we get a change in sentiment around the RBA at around June, September next year. I think it will take that long, but I think mid next year, things really start to change. And what we know from the property market is that the property market tends to move before the central bank moves. Property investors tend to look through 2-3 years what's coming down the pipeline. And one of the biggest problems that we've had in real estate is a lack of supply. And that supply actually gets worse next year. It doesn't get better. So I think prices that have held up relatively will continue to do so. And I think once investors start to get a sniff or a hint that the RBA has moved near the top, then we start to get a bit of a change. I'm reading too much into the future, but I always try to look, at least 3 to 6 months from where we are. And I'm going to be watching this closely. And if I'm wrong and if I've misread these October numbers, I'm going to come out and correct myself because that's important too. So this is, I think, a sign that the economy is starting to slow. And I think that slowdown peaks in June next year, and that changes the RBA sentiment.